Um, so in the spring of 1720, Sir Isaac Newton,
Right, the gravity guy.
yeah, exactly, the man who quite literally invented calculus, father of modern physics,
Mm.
he lost the modern equivalent of like over $3 million in the stock market.
Which is just wild to think about.
It really is.
Yeah.
Because, it turns out that being a certified generational genius, well, it just does not protect you from being a completely terrible investor.
No, it really doesn't. It's actually one of the most striking historical footnotes you'll ever come across. I mean, Newton could mathematically calculate the elliptical orbits of celestial bodies millions of miles away,
Right.
but he was just completely destroyed by the financial madness of the crowd right in front of him.
Yeah. So welcome to today's deep dive. We are looking at a stack of sources today centered around Benjamin Graham's classic text, The Intelligent Investor.
Specifically focusing on the updated commentary by financial journalist Jason Zweig.
Exactly. And our mission today for you listening is to kind of explore Graham's philosophy on building wealth, right? We want to see if behavioral discipline can actually outperform raw intellect.
Yeah, because Wall Street is, they're constantly trying to sell you on complex formulas and algorithmic precision.
Oh, totally.
Yeah.
But the sources we're looking at today argue that successful investing has almost nothing to do with your IQ and, well, absolutely everything to do with your temperament.
Exactly. Graham's framework essentially requires us to completely redefine what the word intelligence even means in a financial context.
Yeah.
He argues it's a trait of character, not of the brain.
Okay, let's unpack this because I want to actually dig right into that Newton story. It just perfectly illustrates this whole idea.
It really does.
So Newton owned shares in the South Sea Company, which at the time was like the hottest stock in England. And at first, he actually sensed the market was getting completely detached from reality.
He saw the bubble.
Right. He muttered something about being able to calculate the motions of heavenly bodies, but not the madness of the people. So he smartly sold his shares. He pocketed a massive profit.
But he couldn't stay away, could he?
No, he totally couldn't. Just months later, he's watching all his friends getting absurdly rich on paper as the stock just kept soaring.
The FOMO was...
Oh, swept up in the sheer FOMO, the fear of missing out. Newton jumped back in, and at a massively inflated price, too.
Ouch.
Yeah, and then the bubble bursts, and he loses 20,000 pounds,
Yeah.
which is when he banned anyone from ever saying the words South Sea in his presence again.
I mean, I would too. And what's fascinating here is if you think human nature has somehow evolved since 1720, the sources point us to a much more modern equivalent.
Oh, the hedge fund.
Yes, the spectacular collapse of the long-term capital management hedge fund back in 1998.
Right.
This wasn't just like a group of smart guys. This fund was run by an absolute battalion of elite mathematicians, computer scientists, and literally 2 Nobel Prize-winning economists.
Robert Merton and Myron Schools.
Exactly.
I mean, these are the guys who wrote the academic formulas for how financial markets are even supposed to price risk.
Precisely. And the mechanics of what they did are just fascinating. LTCM didn't just, place bets on stocks going up or down.
Right.
They used incredibly complex computer models to find tiny microscopic price discrepancies in global bond markets.
Fractions of a penny.
Exactly. Because the profit margins on these discrepancies were so small, they had to borrow massive amounts of money to make the trades even worthwhile.
So heavy leverage.
Staggering amounts of leverage. I mean, they had about $4.7 billion in investor equity.
Okay.
But they borrowed over $100 billion to amplify their trade.
Wait, let me play devil's advocate here for a second.
Yeah.
If they had the smartest guys in the room, literally, and their math was objectively correct, why did they blow up?
Well, because their mathematical models assumed that markets behave rationally. But in 1998, Russia unexpectedly defaulted on its debt, and it just sent global markets into an absolute irrational panic.
People freaked out.
Exactly. Investors weren't looking at math anymore. They were terrified, fleeing to the safest bonds they could find and just dumping everything else.
Wow.
LTCM's models dictated that the markets would eventually return to normal. But as the famous saying goes, the market can stay irrational longer than you can stay solvent. Right. Faced with a complete lack of emotional discipline and just catastrophic leverage, they lost over $2 billion in a matter of weeks.
That is insane.
And they nearly capsized the entire global financial system in the process.
So if I'm listening to this, I'm thinking, if Isaac Newton fails and a room full of Nobel laureates backed by supercomputers fails,
Yeah.
how do you and I even stand a chance?
Yeah, it's a fair question.
Well, Graham's text offers a really illuminating analogy to help you survive this. He basically compares the financial markets to casino gambling.
Mm-hmm.
When you are speculating, like just betting on the daily fluctuations of a stock price, you're essentially playing the casino's games. You're at the roulette wheel. Sure, you might win a few spins, but the house always wins eventually. However, in true investing, the sources argue you actually cannot lose over a lifetime, provided you play by the strict rules that put the mathematical odds squarely in your favor.
You become the house.
Exactly, you become the house.
And drawing that hard line in the sand between investing and speculating, that is the foundation of Graham's entire philosophy.
Right.
He argues that Wall Street deliberately blurs that line. The financial industry actively gamifies speculation because, well, making you trade frequently is their core business model.
Right, because every time you buy or sell a stock, the broker makes money, regardless of whether your portfolio actually goes up or down.
Precisely.
I want to clarify exactly what Graham means then. Like, what is the strict, undeniable definition of an investment according to this framework?
So, Graham states that an investment operation must meet 3 distinct criteria.
Okay.
First, it requires thorough analysis of the underlying business.
Right.
Second, it must promise the safety of your principal, meaning you aren't risking total ruin.
Makes sense.
And third, it must aim for an adequate return.
Okay, I have to stop you there.
Yeah.
Adequate. I mean, nobody downloads a brokerage app hoping for an adequate return. We want to make a killing, right?
Sure, yeah.
Isn't Graham's advice incredibly boring? Like, why shouldn't you try to double your money if you think you spot a winner?
It is entirely by design that it sounds boring. Graham's argument is that the desire to make a killing is exactly the psychological lever that Wall Street pulls to get you to abandon analysis and start gambling.
Oh, wow.
Yeah, the pursuit of extraordinary returns inevitably requires taking extraordinary, uncalculated risks. And historically, when people chase the extraordinary, they usually end up losing their principal entirely.
Here's where it gets really interesting, though, because that brings us to a perfect historical example from the sources. The late 90s dot-com boom.
Oh, yeah, a classic.
If you want to see people abandoning thorough analysis to chase extraordinary returns, look at Juno Online Services.
Right.
So in December 1999, they unveiled their new business plan. They announced they were going to offer all their retail internet services completely for free while simultaneously spending tens of millions of dollars on aggressive advertising.
So their plan was to just bleed money.
Their literal stated business plan was to hemorrhage as much money as physically possible.
And, I mean, you would think a company announcing they plan to lose money on purpose would see their stock just plummet.
But the exact opposite happened. The stock shot up from about $16 a share to over $66 in just 2 days.
Which makes 0 sense analytically.
Right, but why? Because the psychology of that era dictated that, eyeballs and capturing market share were literally all that mattered.
Yeah, people believe that if you just got millions of users, you would magically figure out how to monetize them later.
Exactly. Investors weren't analyzing balance sheets at all. They were buying a ticker symbol just because the line on the screen was going straight up.
They were just playing the momentum. And of course, reality eventually reasserted itself.
Oh, big time. A year later, Juno stock had collapsed to around $1.
Yeah, and that entire era fundamentally altered investor psychology. The sources note that in 1973, the average mutual fund held a stock for nearly 5 years.
Okay.
But by the year 2002, that average holding period had shrunk to just 11.4 months.
Wow, less than a year.
The market transitioned from a place where you owned pieces of real businesses into this high-speed national video game.
And to make this high-speed video game feel less like reckless gambling, Wall Street loves to market these supposedly foolproof mechanical formulas to you.
Yeah.
They package pure speculation to look like rigorous scientific analysis.
It is a brilliant marketing tactic, honestly. Take a strategy that was heavily promoted in the 90s called the Foolish Four.
Right, I've heard of this.
The pitch was that you could crush the market with minimal risk by following this convoluted set of steps. You take the 5 Dow Jones stocks with the lowest prices and highest dividend yields. Uno, drop the one with the absolute lowest price, put 40% of your money in the second lowest and 20% in the rest.
It sounds like a witch's brew. Like just completely arbitrary numbers.
It is completely arbitrary. Or consider the January effect, which was the widely observed historical tendency for small-cap stocks to suddenly jump in price right around the turn of the new year.
But Graham proposes a law that explains why these mechanical formulas will always self-destruct, right?
Yes, exactly. Graham's law dictates that the moment a market-beating formula is widely publicized, it just ceases to work.
Makes sense.
The mechanism behind this is simple market arbitrage. Let's take the January effect. If everybody reads a book saying small stocks surge in January, what do?
They buy them in December.
Exactly. They decide to buy those stocks in December to get in early. That sudden wave of buying pushes the prices up in December, completely eliminating the bargain that was supposed to happen in January.
Yeah.
As for statistical flukes like the Foolish Four, time simply exposes that they never possessed any underlying business logic to begin with. In the year 2000, the stocks in the Foolish Four strategy plummeted by 14%, while the overall Dow index only dropped 4.7%.
Now, I know the natural pushback you might be feeling right now listening to this. You might look at your own portfolio and say, well, look, I day traded a meme stock last year and I made $3,000. If the strategy made me money, it must be valid.
Yeah, that's a common defense.
But the sources offer a brilliant analogy for this. Just because you drive 130 miles per hour down the highway, weaving through traffic, and you happen to survive the trip without crashing, that does not mean driving 130 miles per hour is a safe or correct way to drive.
No, definitely not.
Short-term speculative luck is not a brilliant financial strategy. It is simply surviving a high-speed joyride. If you keep driving like that, the math dictates that you're eventually going to get a wall.
That is the perfect way to frame it. Speculation is the loud, flashy threat to your wealth. It's a spectacular car crash.
But, listening to all this, it makes me wonder why we are so desperate to take that 130-mile-per-hour joyride in the first place.
Yeah.
I think the sources point to a deep psychological driver here. We speculate because we have this underlying panic that if we just sit still, if we play it safe, we're actually losing money.
Yes.
And that brings us to the silent, invisible threat to your wealth: inflation.
Yes, the silent thief. Inflation destroys your purchasing power over time, and it is incredibly dangerous because it preys on a psychological blind spot called the money illusion.
So what does this all mean? Like, the mechanics of the money illusion are fascinating. Let's say you get a 2% raise at work in a year when inflation is running at 4%.
Okay.
Generally, you feel pretty good about it. Your paycheck went up.
Right, more money.
But if you take a 2% pay cut in a year when inflation is dead flat at 0, you are probably furious. You feel robbed.
Yeah.
Yet mathematically, the net result in your actual purchasing power is absolutely identical. In both scenarios, you are 2% poorer.
Exactly.
But our human brains are wired to focus on the nominal dollars, the physical number on the paycheck, rather than the real inflation-adjusted purchasing power.
And if we connect this to the bigger picture, because people are so terrified of that purchasing power evaporating, the standard financial advice you hear everywhere is just buy stocks to beat inflation.
Right. Everyone says that.
People assume that because stocks generally go up over decades, they are a perfect shield.
But the sources totally tear that assumption apart.
They do. The historical data proves that when inflation gets out of control, specifically when it exceeds 6%, stocks actually perform terribly.
Really?
Yeah. In the study cited by the sources, stocks lost money in 8 of the 14 years where inflation was over 6%.
But why exactly does that happen? I mean, if a company makes shoes and inflation hits, can't they just charge more for the shoes and keep their stock price up?
Well, in theory, yes. But the mechanics of high inflation are much more destructive. When inflation spikes, a company's input costs, raw materials, factory energy, employee wages, they often rise much faster than the company can safely raise prices on their customers.
I see.
If they raise the price of those shoes too high, consumers whose own wallets are being squeezed by inflation at the grocery store simply stop buying shoes.
Makes sense.
Corporate profit margins collapse and the stock price plummets with them. And conversely, if the economy experiences deflation, where prices actually fall, stocks suffer, then too.
Because consumers delay their purchases, thinking, why buy today if it will be cheaper tomorrow?
Exactly.
So if stocks aren't the armor we thought they were against inflation, where do you go? Gold. I mean, I always hear gold is the ultimate inflation hedge.
Graham actually warns against relying heavily on gold.
Oh, really?
Yeah, the problem with gold is that it yields absolutely no income. A bar of gold doesn't pay a dividend, it doesn't invent new products, and it actually costs you money to safely store and insure it.
That's true.
It relies purely on the hope that someone else will pay more for it later.
So what are the actual practical tools Graham recommends to fight this silent thief?
The framework highlights 2 specific tools: The first is REITs, or real estate investment trusts.
Okay.
These are publicly traded companies that own, operate, and collect rent from commercial and residential properties.
Right.
The mechanism here is simple. When inflation rises, property values generally rise, and landlords can raise the rent, providing a natural defense against the erosion of your purchasing power.
Nice. And
The second tool is TIPS, which stands for Treasury Inflation Protected Securities.
Okay, let's look under the hood of TIPS because the way they work is really unique.
Yeah, they are.
These are bonds issued by the U.S. government, but unlike a regular bond, the actual principal value of a TIPS-S bond automatically adjusts upward as inflation rises, tied directly to the consumer price index. So your principal is safe from default because it's backed by the government, and your purchasing power is structurally protected from inflation. But, and this is a massive warning for you listening, there is a serious catch.
There is always a catch when the IRS is involved.
Exactly. When inflation heats up and the government adjusts the underlying value of your TIPS bond upward, the IRS taxes that increase in value as income for that specific year.
Yep.
But here's the kicker. You haven't sold the bond. You haven't received a dime of that cash. It is purely a paper gain on your account statement, but you owe real taxes on it right now. It is phantom income.
Which is incredibly frustrating for an investor.
Right. So if TIPS have this structurally built-in tax nightmare, how are you actually supposed to use them?
The strategic placement of the asset is the key here. Because of that phantom tax, Graham's modern commentary insists you must keep TIPS safely sheltered inside tax-deferred retirement accounts, like an IRA or a 401k.
Oh, brilliant.
By keeping them in a tax-advantaged account, the bond's value can compound and adjust for inflation year after year without generating a massive unexpected tax bill on your current income.
That makes perfect sense.
Yeah.
Okay, so we've mapped out the behavioral traps of speculation, and we understand the silent mechanics of inflation and how to use REITs and TIPS to fight it.
Right.
Now let's pull all of this together into the final practical state. According to the sources, how exactly should you construct your portfolio to defend against both the loud crashes and the silent thief?
This brings us to Graham's golden rule for the defensive investor. He recommends establishing a baseline 50-50 split between stocks and bonds.
Okay.
And he insists on a strict boundary. You should never hold less than 25% or more than 75% of your funds in either category.
I want to aggressively push back on this, not against Graham, but against the conventional Wall Street wisdom you hear parroted by almost every financial advisor today.
Oh, the age rule.
Yes. They always teach this arbitrary age rule. You've probably heard it. Subtract your age from 100, and whatever number you get is the percentage of your portfolio that should be in stocks.
It's everywhere.
The sources argue this is completely absurd, and when you think about it mechanically, it is. Let's look at an extreme example.
All right.
Say you have an 89-year-old retiree. They have a massive guaranteed pension, millions in the bank, and their only financial goal is to leave a massive inheritance to their grandchildren. Under the 100 minus age rule, they should only have 11% of their money in stocks.
Which is crazy.
Right. Why? They don't need the cash for daily living, and their grandkids have 50 years to let those stocks grow and weather market crashes.
It makes no logical sense in that scenario.
Exactly. And on the flip side, what if you are a 25-year-old who is saving up for a massive down payment on a house, and you need that cash in exactly 12 months? The age rule says you should be 75% in stocks.
That's way too risky.
If the market tanks 20% next month, you just lost your house.
Yeah, and this raises an important question, which is why Graham's framework pivots completely away from your birth year. Your asset allocation shouldn't be dictated by your age. It must be dictated by your life circumstances.
Right.
You have to ask yourself the hard questions. How secure is your job? Are you single? Or are you supporting a spouse? Do you have young children heading to college? Will you need to pay out of pocket for aging parents?
So it's very personal.
Extremely personal. Your true risk tolerance is defined solely by when and why you might suddenly be forced to pull cash out of your portfolio during a market panic.
To help you manage those life circumstances, I want to explain a concept from the text using a mechanical analogy.
Sure.
Graham suggests periodic rebalancing of your portfolio. Think of your investments not as a vehicle you are driving, but as a thermostat in your house.
I love this analogy.
It's great, right? Attempting to time the stock market is like desperately standing at the window, sweating, trying to predict if it will rain or shine tomorrow so you can manually adjust the temperature. Graham says, just Set the thermostat to a comfortable 50-50 split based on your life circumstances and step away.
You let the mechanism do the heavy lifting.
Exactly.
Yeah.
Let's say a massive irrational market boom, a heat wave, pushes the value of your stocks up so high that they now make up 75% of your total wealth.
Okay.
The thermostat automatically triggers. It tells you to objectively sell off some of those expensive stocks and use the profits to buy bonds until you are balanced back at 50-50.
Right.
If a market panning happens, a freeze, and your stocks plummet down to 25%, the thermostat triggers again. It tells you to sell some of your stable bonds and buy those incredibly cheap stocks.
Yeah.
By simply following the thermostat, you are mathematically forced to buy low and sell high without using a single ounce of emotional guesswork or market prediction.
It entirely removes the human element of panic. You never buy more stocks just because your neighbor's getting rich, and you never dump them just because the news anchors are screaming about a recession.
You just read the thermostat.
You just read the thermostat.
So, to recap the journey we've taken through the sources today.
Yeah.
True investment intelligence has very little to do with how high you score on an SAT test. It is all about mastering your temperament.
Absolutely.
You survive the market by keeping any urge to gamble quarantined in a mad money account, strictly under 10% of your wealth. You defend against the structural, silent thief of inflation using tools like Tippy's S inside tax-advantaged accounts. And most importantly, you ignore your age and build an autopilot, a thermostat, based on your actual life circumstances.
If you internalize that framework, you insulate yourself from the noise. You become the house instead of the gambler at the roulette wheel.
But I want to leave you with one final thought to chew on today. Building on Graham's philosophy, but applying it directly to the modern world. Graham wrote about the dangers of brokers gamifying the market decades ago, when you had to call a guy on a rotary phone to place a trade.
Right, it took effort.
Today, we have zero-commission apps with digital confetti, push notifications, and algorithms designed by behavioral psychologists to trigger dopamine loops in your brain every time a stock ticks upward.
It's dangerous.
Wall Street has literally put a gamified supercomputer in your pocket. So perhaps the ultimate test of the intelligent investor today isn't whether you can analyze a balance sheet or predict the next tech boom. Perhaps the true test is whether you have the emotional fortitude to look at a device engineered specifically to break your discipline, turn off the notifications, and simply trust your thermostat.